While most of your clients have probably never even thought about buying investment real estate for retirement, it's very likely that their default mindset is to automatically invest all their retirement money in the stock or bond market in the form of mutual funds or 401ks. The question then becomes, is that really the best choice for them, or is there something better out there that they could be investing in? Not only may there be something better, we're going to prove it mathematically. So stick around, you're not going to want to miss this. Hey, it's Russ from the Neon Bros, where we believe if you teach your clients financial literacy, you will generate more sales, more commissions, and a greater net worth for both of you. Today, we're going to explore the role that volatility plays in an investment's performance and answer the question, which is better for your client's financial health? Smooth returns like real estate, choppy returns like the stock market, or does it not matter at all? If this sounds interesting to you, like this video and subscribe to our channel. Let's answer the question by looking at an example. If you have $100,000 and are deciding between investments with no volatility, low volatility, high volatility, or extreme volatility, each with an identical 10% average rate of return and each compounded annually, here's how it might shake out. I'll share my screen with you now. Okay, so what we have here is a chart with a number of different scenarios here. I had to take my glasses off, but I hope you still recognize me. It's kind of like, Superman versus Clark Kent and the whole comic strip there. They never knew that they were the same person just because he took his glasses off. But hopefully you still know it's me. So here, in the first scenario, we've got an investment that has no volatility. In the second scenario, we have one with low volatility. Let me see if I can make a little mark here. Here's low volatility, and here's the no volatility up here. And then in order, then we have one with high volatility over here. And down below, we have extreme volatility over here. So let's just go through. Let's pretend we have $100,000 to invest, and we have a 10% average rate of return, and we're going to show how different the average rate of return is versus the actual rate of return. The actual rate of return is what you're really interested in. And I'm going to show you what the difference is right here. So in year one, let's just take this example where there's no volatility at all. So in year one, the investment makes 10%. That equals $110,000. Year two is another 10%. And again, we're compounding annually. So that means that we start year two off with 110 and then add another 10% to it, which leads to 121,000. Year three, another straight 10%. This is the purest version of getting a 10% return. Year three is another 10%, which equals 133,100. Year four, adding another 10% to the 133,100, gets you 146,410. Year five, we start off with 146,410, add another 10% to it, equals 161,000 and change. And then finally in year six, we add 10% to 161,051 to get a grand total of 177,156. So you could see from year one to year six, we made an extra $77,000 and change. So that's kind of the benchmark to go by without any volatility at all. So that is a pure straight 10% every year, which is a total actual return of 10%. So that means if you were to do a present value calculation starting with $100,000, and I'm not going to get into this, but there's a special kind of calculator that you could use, a financial planning calculator that does present values and future values. If you start off with $100,000 and incorporate a 10% rate of return for 6 years, it'll come out with 177,156, which is exactly what we came up with. So we know that in this case, the actual rate of return and the average rate of return are actually the same. But now let's go to the low volatility scenario here. And what we're going to do is we're going to make it, instead of getting a straight 10%, we're going to make it so that it averages 10%, but with just a little bit of variance. So we're going to say we're going to exceed 10% by 2 to make it 12% the first year, and then we're going to be deficient by 2 in the second year, and then exceed 10% by 2, get 12%, and then be deficient by 2 with only an 8%. So that's going to average to 10%. You could see it, 12 and 8. You add up 12 and 8, that's 20, divided by 2, it's 10. And we just keep repeating the pattern over and over again. But you could see by having just a small bit of volatility, here's what happens is that in the first year, you have more, you're getting a 12% return on the initial 100,000. So that equals 112,000. Then in the second year, we're only increasing it by 8% rather than 12%. So that equals 120,960. Then we take the 129.60 and add 12% to it, and that's going to add up to 135,475 and change. Then we take that 135,475, multiply it by 0.8% or 1.08 in this case. That'll equal 146,313. Use that as our starting balance and add 12% to that, which equals then at the end of year 5, 163,870. And then adding another 8% to the 163,870 comes out to 176,980. So we've made 76,980 for these 6 years. So you could see if our average rate of return is 10%, our actual rate of return is only 9.98, just because that little bit of variance each year. So you could see having a little bit of volatility hurts you. So now let's take a look at high volatility and see what that does. You could tell it's probably going to hurt, but let's go through it. So the first year, let's say that we make 20%. So we're going to just do an alternating pattern of 20% and 0, because 20% and 0 divided by 2 for 2 years is 10. And we're going to just repeat that pattern over and over again. So that's a pretty extreme level of volatility, but it's not negative yet. So let's just start this off. We start off with 100,000. We add 20%. That adds up to 120,000. Year 2, we made nothing, so we're still stuck at 120,000. Year 3, we added another 20% to this 120,000, which brings our total up to 144. Then year 4, we get 0 again, which means we're still staying at the 144 for year 4. Then we start year 5 off at 144,000, and then we add 20% to it. And so that adds up to 172.8 for a grand total up through year 5. And then year 6, we did nothing, got 0% return. So we're still stuck at the 172.8. So you can see now over 6 years, our grand total gain is only 72,800. That now equals a 9.55% return. So we're losing by having volatility. So let's go to the furthest example, now an extreme volatile example. And now in this case, we're actually going to have some years where we're negative. So we're going to have really strong positive years followed by some really strong negative years. That all adds up to 10% average rate of return. So the 40% in the first year, multiply that by our initial starting value of 100,000, that brings us up to 140,000. But now we're losing 20% in year 2. So now our total goes back down to 112,000. Then in year 3, we take the 112, multiply it by 1.4 to equal a 40% return. And that brings us up to 156,800. Then we take that 156,800. We subtract 20% from it, which would be like a 0.8, 156,800 times 0.8 would be like 80% of 156,800. That would be a 20% reduction. That brings our total down to 125,440. Then for year 5, we take that 125,440, multiply it by 1.4, a 40% return. So that brings us up to 175,616. And then we finally lose money again in year 6. We lose 20%. So that's again 175,616 times 0.8, which brings us to 140,493. So that means now, because of the volatility, we only made 40,493 in these 6 years when we started with 100,000, which means that our total gain in actual terms is only 5.83. So because of the volatility, even though we have these really strong positive years, because of the negative years, it brings our total down to roughly, a little more than the what you could get from a CD in most average years. Maybe a multi-year CD, but not that much better than a CD. So what this tells us now is that the famous average rate of return, often quoted by stockbrokers and financial planners, is highly misleading. What's more instructive for the purposes of your client's annual wealth building is the actual rate of return, because it's a more accurate reflection of how their investment actually performed and how much money they will then really have. This is something you should be doing for yourself as well, compounding your own wealth this way. So as you can see in this example, all four investments had identical 10% average rates of return, but the extremely volatile investment cost your client over 4% of growth and more than $36,000 in only 6 years compared to the investment with no volatility. So the takeaway is that if your client has a choice between highly volatile investments like stock or crypto versus more steady performers like real estate, all things being equal, the steadier performing investment may outperform the volatile one. So that's food for thought there. So that's another selling point for why you should have this conversation with your clients about whether or not the investments that they have right now in their 401k or in their IRAs is something that's more akin to a volatile investment as opposed to a smoother performer like real estate. Successful real estate agents know one thing: you're only as strong as your pipeline, but keeping it full shouldn't feel like a grind. Cold calls, awkward networking events, and endless mailers might get your name out there, but they drain your time, energy, and enthusiasm. That's why we built Opportunities Everywhere, a smarter, easier way to attract clients you actually enjoy working with. Instead of chasing leads, our system creates them for you. Using a library of short, engaging 10-minute videos, it quietly teaches everyday people how and why to invest in residential real estate. Then, when they're ready to act, they come straight to you. The best part? These aren't just one-time buyers. They're future investors you've shaped from the start, clients who understand your approach, trust your guidance, and keep coming back for their next purchase. If you're ready to fill your pipeline with the kind of clients you've always wanted, visit opportunitieseverywhere.com to learn how. So just to reiterate, this means that if your client has a choice between an investment that offers a fairly stable history, or at least one whose fluctuations vary within a narrower range, such as real estate, she may be mathematically better off selecting that as compared to a wildly volatile investment which offers spectacular spikes but significant crashes, such as stocks or stock mutual funds, even if their ending averages are identical. As you can see, mathematically, it doesn't all merely even out on its own, and this is important to teach your clients. The reason this happens is that large losses take a more meaningful and lasting bite out of your client's account balances than do equal but opposite gains. It works like this. Let's say you have a stock that trades at $100 a share and gains 50% in year one, but then loses 50% in year two. Are you back to even? At first glance, the average rate of return says that you are, but are you really? Not at all. If you began at 100, let's just do the math together. If you began at 100 and gained 50%, you ended year one at 150. But then you lost 50% in year two, so you ended year two at 75. So your average rate of return is zero, but your actual rate of return is an annual loss of 13.4% over the 2 years. It's easy to make the mistake of seeing 2 years in a row of equal but opposite performance and think that the 2 years just simply canceled each other out. But the truth is much more damaging. The other factor to bear in mind is that the order in which the performance occurs has no effect. If the strongly negative year occurred first, followed by the strongly positive year, the math still works out the same. So again, a stock trading at $100 that loses 50% in year one is then worth 50% at the end of the year. Then when it gains 50%, it ends year two at the same $75 as we had in the first example. It doesn't matter whether the order is reversed or not. The main takeaway here is that volatility matters. It does matter to your clients how their investment finally arrives at its destination, and they will likely find that smooth performance is not only much more tolerable for their psyches, which allows them to stay on plan more comfortably, but may also reward greater gains. Every tip and trick that helps them squeeze just a little bit more efficiency out of their nest eggs shaves valuable time off of their working years and makes you much more valuable to them. These small tweaks could save a year or two off of a working career. Success comes down to having more tools available to be deployed no matter what the current financial landscape looks like. So if this video was helpful, please like it and subscribe to our channel. And remember, ask your clients if they believe too much of their retirement savings are committed to investments that swing too much in price. If they say yes, you have this conversation with them, and this one simple question may open up some amazing opportunities to fund a property purchase with money in an IRA, an old 401k, or a brokerage account that they never thought about using. That's the whole point of this discussion, to help you sell more houses. Once their eyes open to that possibility, you're off to the races. If you can use financial literacy as a mechanism to gain buy-in as to why they should buy additional houses, you'll be using an approach most agents beyond those watching this channel are ignoring. It's a blue ocean of opportunity for you. If you need some help with any of what we discussed today, reach out at my contact info below, and I'll try to help, or I may even make a video on the topic to answer your question. Well, that's all for today. Until next time, I'm Russ from the Neon Bros, wishing you and your clients a lot of success.